Gang, guys, what up? All right, so I want to get right to this video. This video is probably going to be pretty long. I want to explain everything about technical analysis, with the charts in a YouTube video. This will give you guys some content, for free. This is not even, part of my course. This is just for my YouTube. Everything about technical analysis. Obviously, my course is a lot more advanced and in depth, and obviously for my students, but this, for you guys to at least know about, trading or the other things that I'm going to post after this. You guys got to know technical analysis as well, especially for your own good and for your own charts. So I want to touch on Japanese candlesticks, key levels, aka support and resistance, moving averages, market patterns, Fibonacci, trend lines, you name it. Everything they got to do with technical analysis, I want to talk about it. So the first thing we want to do, like I said, I'm not talking about, what is Forex, the basis behind it and how to, I'm not doing that. I did that in my first video. And by now you guys should know what is Forex and all that extra stuff. The only thing that I'll talk about that, is around what is Forex is this right here. So we're on Euro USD. The first currency is called the base currency. The second one is called the quote. So what that means is whatever price is going up or down, that's basically the first, country, economy, whatever you want to call it, in the pair in comparison to the second one. So if price is going up, that just means euro is going up in comparison to the US dollar. If the price is going down, that just means euro is going down in comparison to the US dollar. Obviously, if the DXY, aka the United States dollar index, US dollar as a whole and its economy is going up, this pair is going to go down because euro is first. Whatever the market is doing reflects the first, one out of the pair. So if the US dollar was very, very strong, this would go down. So, but a pair like USD, JPY, I'm sorry, get this over. USD, JPY, since the US dollar is first, it's the base, currency in the pair. If the US dollar was strong, this pair would go up because US dollar is first. That's the only thing that I'll say about, the what is Forex, background stuff, but I just want to focus on technical analysis. So when you have a chart, you want to go to tradingview.com. And if I just back out a little bit, just so you guys can see it, you go to tradingview.com. I can leave the page up. And then you just go right to chart. I don't know why I did that. Let me see if I can go to a regular TradingView page. So you guys can see it. Yeah, there we go. So we go right to chart right here. Go to chart. X this out. And it'll probably go to my actual chart. Oh no, went to a blank chart. Perfect. Okay, cool. So we go to this blank chart. Whenever you have a blank chart, anything you want to know about the market, it could be stocks, Forex, anything, all you gotta do is type it in. You type E, everything comes up. All stock, futures, Forex, CFDs, cryptocurrencies, everything comes up. And you also got to understand, technical analysis applies everywhere. So if currencies is not for you, technical analysis, you can take the same technical analysis and apply it to stocks in terms of stock trading and have the same thing, like the same bullish and bearish lingo and, double tops and double bottoms and all that stuff. All of that still applies. Moving averages, Bollinger Band, all of that stuff with Forex still applies to the stock market. They're both still day trading at the end of the day. Day trading has the same techniques and fundamentals. So when I mean by fundamentals, I mean fundamentals in terms of trading, not fundamental announcements, just like the trading aspect. So first thing you want to do, you want to look at a blank chart, right? And the first thing you got to understand, first of all, up here, I don't know if you guys know this, but these are all time frames. What that means is each candlestick, these are called candlesticks, represent a time frame. So I'm on a W, which means a weekly. That means every single candlestick represents 1 week in the market, every single one. So that means this is the week that we're in right now because the market just opened. This was last week, February 24th, February 17th, my birthday, February 10th, February 3rd, and so on and so forth. You're on to a daily. Each candlestick represents 1 day. So 30 or 31, depending on what month it is, represents one, day in the market. And obviously 30 or 31 represents 1 month. 4 hour, 2 hour, 1 hour, 30 minute. And we have all these different time frames because they help us analyze the market. So we would look at, and I would do this at the end of the video to bring it all together, but we will look at a weekly or a daily time frame. See what the market is doing long term. Like you see weekly, it's been going down for a while. Now it's coming up. Look at the daily, it's been going up for a while. So then we look at a 4 hour or 1 hour to see where can we enter. Because with a daily or weekly, it's going to take 1 day or 1 week for that candlestick to form. We want to get in a little bit earlier than that. You feel what I'm saying? So we go on to the 1 hour or the 15 minute, which means every candlestick represents, 15 minutes. And a bunch of 15 minutes or a bunch of 1 hours, 24 1 hour candles represents 1 day. So they all come together. So obviously, if we go to the daily, or the weekly, let's go back to the last week, which was the February 24th week. This is one big candle. But if we go down to the 1 hour and go down to, what is it, February 24th, that all is represented through, the 1 hour. All these little candlesticks represent that one big candle. So we scaled onto the 1 hour, 15-minute time frame to see where we could enter, buy it since it's going up, because we looked at the weekly and daily and it's been showing us it's going up, and we enter right here and then get in. So these are all time frames. Now, what these candlesticks show us, Japanese candlesticks show us every single thing about the market. So if you go right here, this is a bar chart. It's like really weird to see. This is a line chart, really weird to see. This is a Japanese candlestick. That tells us everything. Let me just get rid of the moving average just so remove the indicators so you guys can see it. I'll get to indicators later in the video. So clear blank chart. So what this tells you for Japanese candlestick, it tells you everything. It tells you the open, the low, the high, and the close. What that means is for this week, we're on a weekly time frame. For this week, I can look at this week and see the lowest point price was at during that week, the highest point, where it opened at, and where it closed at. And this is how you read them. So with a blue candlestick, for me, blue represents going up. Some people have green or yellow, but for me, I have blue. What this means is whenever you see a blue candlestick, a candlestick that goes up, that means price open right here, the bottom of the body. Sometime during this week, price got this low right here. You know what I mean? It got that low sometime during the week. And I can go back to the 1 hour and show you guys, but it got that low during the week. During that week, price also got this high. The reason price is moving right here, right now, is because the market is open. Let me just take this off real quick. You feel me? Okay, cool. Price got this high, right? But when the week closed on Friday at 5 p.m. Eastern New York time, the market closed right here. This is where the market closed at. So you have the open, the low, the lowest point it went to during that week, the highest point it went to, and then the close. These little lines that are trails left behind are called wicks. The wicks tell us, the high and the low. So over here, this is a small candlestick, but it tells you price open here. It got way low up here, but then the buyers bought a lot. So price started to push back up, got this high, but it closed right here. So whenever you see the body that's all filled in, that's just the open and the close. The wicks is the high and the low points. Let me just give you one more example before I move on to the key levels. Just remove it all, actually. Cool. So what this means is basically, long story short, when price opens, price will do this, right? Price will open flat out just like that. Now, price goes down a little bit, the candlestick will be red because price is going down because the open is above where it's at right now. If the open is below, if the open is down here, price will be blue, but if the open is above, it'll be red. So if price is going down just like this, so that means price must have opened up here with this candlestick, and then there's not really much of a wick. It closed down here. So if price closes below the open, the candle will be red. If price closes above the open, like it closed above the open, it'll be blue, signifies going up. So for this candlestick right here, I'm emulating this one right here in particular, right? So that means price open right here, right? And then during that week, price came down to this line, right? During that week. During that week as well, price starts to push back up. Now, when price is pushing back up, there will be a trail that shows you exactly where price was at. So the trail would be right here. Let me just make it over. Perfect. Okay, cool. So when it's like this and it comes back up, there will be a trail left that says, okay, price was here. So as price still is going up, the trail is obviously following it, which is called a wick. And then price starts to do this and boom, go in the other direction, which immediately, I don't know what just happened to now. There we go. Which immediately turns the candlestick blue or green, depending on, how you trade the market or what color you have the market. You know what I mean? Immediately goes blue and it starts to push all the way up here. Before the week closed, price got right here. And then when the week closed, it closed right here. But then price left a trail that said, hey, price was up here. You feel what I'm saying? So that's how you read a Japanese candlestick. It tells you the open, the low, the high, and the close. And that's for all of them. So you got to see, because some have like a much bigger wick up here than down here. Like bodies aren't always, proportionate. There's always going to be like some crazy wick. And I'll get to that in the market patterns, because when you see a bunch of wicks or a crazy wick or a small body but a big wick, that's a pattern that tells you price is about to go in this direction, whether it's up or down. But I'll talk about that in the market patterns. So that's Japanese candlesticks. As far as key levels, which is called support and resistance, support and resistance are major areas that price is at, that tells you, okay, price usually hesitates here and it'll either reject it and go back down or break through it. Or if it's support, which is below, it'll reject it and come back up or go down. So support is always below you, resistance is always above. So what that means is, I don't draw my lines this way. I already made a video, signaling how I draw my lines. I'm gonna get to that in this video. But right now, I'm just gonna show you like where support or resistance technically is. So all it is like, you see where price is stopping at? Like price stopped here, price stopped, here, price stopped here, price stopped here, price stopped here. Wherever price is stopping at, that's like basically where it would be at technically. Like I said, I don't draw my lines this way. I'll tell you exactly how I draw them later, because I did a video on it, I think yesterday. But we'll see. So what all this means is, let me just erase some lines real quick and just make it real simple. Price up here and then price down here, right? Let's take all this out of the way. Let's X out of the bar replay. And then let's just imagine bar replay to here. So all this means is this above right here is resistance, because price is resisting it. Price can't break above, can't break above, can't break above, can't break above. It's resisting it. This is support. What's like the floor is always support. Whatever is below you is support. So this is support right here because it can't break through. Now, if price ever breaks through support, like it will do if I just press play. Breaking through, hurry up and break through already. Breaking through, right? Came back, let me just fast forward it. Cool. So what this means is, this was support for over here. Now that price broke below it, this is now resistance because it's above it. So whenever there's a line or area above price, that's resistance. Whenever it's below price, it's support. So now support over here became resistance. So now it's resistance because it can't break above it. And we get all this, we get all this, we get all this. And now we have this, and it creates a new support level. So now this is now our new support, where it's support, 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 and this is resistance. And if price decides to break above it, now this is support, if that makes sense. So whenever price is above price, or whenever price is above the line, that means it's support. And whenever price is below the line, it's resistance. So how we draw our support and resistance level, AKA the key areas, we know, you guys may not know this, but the banks and the government set these levels. They do all this global trade stuff, and like they know what they want the levels and the exchange rates to be at. So they like even round numbers. So they like 110, 115, 120. You see over here for Euro USD, like these numbers, or a pair like GDP AUD that's a little higher. They're like 190, 195, 2 flat. Like they don't like 1.13522. You know what I mean? Like you shouldn't have your support and resistance levels right there. You should have major, weekly and daily support and resistance levels, AKA key areas, and then scale down. So what I'm doing right now is I'm looking right here and just looking at it. I know 110 is a major area. Just me, let me just X all this out. Boom. I know 110 is a major area. So I'm gonna place a line right here at 110 flat. Coordinates 110 flat, right? Let's make the line a little bit. I'll keep the line at that. So I know price is there. So I'll keep my area at 110 flat, and then 115, which is way up here. You see how price stopped up here? Like I said, I'll get to, how it makes sense in a second. But this is what the government and the banks like. They like these levels. You feel what I'm saying? Like 111, 112, 113, 114. We just don't want to have, too many, like a line at 14, 13, 12. We don't need all those lines. We just need like the major ones, because price can easily break through those levels because like it's not 110, it's not 115. It's not like a major area. So we have these major areas at 110 and 115 and even 105, way down here, of course. But I'm gonna keep these two levels right now. Right now, this is resistance and this is support. You gotta understand, price will never get to one specific area and just stop, or one specific number. It'll get to the area. So what we want to do right now is we want to create like a little box, a rectangle, and just draw it across to signify, make it black, to signify, sorry, pardon me. Take this off, cool. To signify the area, so like around the area, so 110, 200, 110, 100, 110, 109, 900, like somewhere around that area, price will like reject it, stop, and reverse. So we have that area. We're gonna do the same thing above. What we're gonna do is just click this and just clone it and bring it above. And you can make whatever color you want. I just like, this black color, this grayish color. So I have these two areas right here. Now, the midpoint, you want to have a midpoint too, between 115 and 110 is 112,500. That's the midpoint. 112,500 is the middle of 110 and 115. So I'll get like a ray here and place it at 112,500. Or I'll get a line actually. I'll get a ray. I'll keep the ray. 112, let's get 112,500 flat, make it accurate. Boom. And we just get the same thing, the same type of box around it, right? So now we have our major right here. It would be, I'll just write major resistance level 115. And right here, major, this is technically resistance right now. I mean, support, it's support, it's actually support. Yeah, I'm bugging, 110. If it was down here, that would definitely be resistance. But since price is above it now, that's support. So it's a major support level. This is a mid level. So we have these levels. You see how price stopped at the mid level, stopped at the mid level, stopped at the mid level, stop, got above it. You see what I'm saying? Like these are your areas. These are your key areas. Now, that doesn't mean price won't stop like it did right here at a weird level at 110, 800 or weird levels. These are your major levels. These levels never come off. They should never, ever come off your charts. You see what I'm saying? But you can scale down to a daily or a 4 hour. You see how nice it is? You just scale down and you can draw. See how price stopped here before going down or stopped there? You can draw a little box if you want to. Let me make this blue though, or gray. You can draw a box for like a 4 hour, resistance or 2 hour, but these get deleted. So whenever price, like a price is resistance off of here, boom, 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 goes below to support, reject support comes up and like retest this resistance level, but then breaks below. Once it breaks all the way down here, this can get deleted. You know what I mean? Now that price is coming back up above it, you can bring it back obviously and just drag it over. And now we may see price hesitate right here before pushing up. But like I said, these all get deleted. This is all we're talking about, just the major areas. These are your major areas and how your chart should be drawn on and kept on. You feel what I'm saying? Now we can, price is not way up here, so we can just draw it back on. We can delete this level and just keep it simple for now. Just keep these two, and obviously when price breaks above, we can just put it at 115. But just know that you keep your major areas on, you keep them on. And now look at this. Price gets right here, it like rejects, or you can see right here, starts to move around, couldn't really break above, finally breaks above it, and now boom, we're up to the races. So whenever price gets to a key level, it'll always, hesitate before breaking. It will never break straight through. Like it'll see this big wick here before finally breaking through. You get right here, what does price do? It doesn't break above 112, it creates a wick. This is called technically a shooting star or inverted hammer, whatever you want to call it. You feel what I'm saying? But we'll get to that in the major market patterns. But rejects this level. This is telling you it's going down. Whenever you see a price pattern, when I get to the market patterns, reject the level, get in. It's going down, sell, and it's going to go down to the next level. You feel what I'm saying? So, and same with below it. So that's 112, 110. Right below it, the next level would be what? 105, right? 105 flat. And we would have the same box. I wouldn't keep this on because it's way too low, just like the 115. Like I don't need it on. I just want to give you guys an example. So price would be way down here, way down here. 105, 110, 115. The mid level of 105 and 110 would be 107, 500, between 105 and 110. So it'd be 107, 500. We get a ray, 107, 500, right? We get our box. Boom, right here. We can delete this because price didn't get there. And you can see the accuracy of price when it breaks this level of 110. Where does it go? It goes right to 107, 500, this area, and then goes back up. If it were to break below this area, we would look at 105 to be our next target. But since it rejected and gave us an engulfing pattern, which is a market pattern I'll get to again, it goes right back to 110. And now we're looking at price getting to 112, 500 right now. I believe price will maybe come back down and retest a little bit, but now since we're above it, we're looking at 112, 500. Just in general, as an area to get to, because price can, if it retests this area and push back down, it can go right back down to 107, 105. But if it retests and it comes back up, We're looking at 112. This will be our next area that we're looking at. You see how price is stopping at all these levels over here though, like in between? Like I said, you can easily scale onto a 4-hour or 2-hour, draw a mini box around here and just make it whatever color. You can see prices right there right now, just like it stopped here, right? Stopped here and then got above it. Stopped here as support, went up. Use this as resistance, went back down. Use this as support, went back up because it's always above it. Use this as, support, broke below support. Use as resistance because it was above it, went down. Now it's using it as resistance again. And if it breaks above, this will be support. And if it breaks above, we're looking at 112. You feel what I'm saying? If it doesn't come back down and retest, it'll go down. So that is support and resistance in the major key levels. Like I said, feel free to draw many support and resistance levels. I don't draw straight lines as support and resistance because price will never get to a specific number and reverse or break through. It'll be the area. So you can put like a line at a number, but make sure you draw an area around it because it's somewhere around that area. You feel me? Like even right here, price didn't get to 107,500, but it got to the area. It got to 107, 700, 107, 600, like that. Anywhere around the area is still fine. So that's support and resistance. So we keep these levels on. And right now we're looking at for trend line. So if you don't know what a trend line is, let me go to your USD, a blank chart. I'm gonna come back to this chart though. A blank chart, right? Which I think I already have it here. Wow, okay, cool, perfect. So the markets will never go straight up. I don't know what's this doing. Oh, market will never go straight up or straight down. Never. What the market will do is it'll create like a pattern, like waves. So for an uptrend, which the market's going up, because first of all, you should know this already in Forex, but like there's 3 ways the market can go. An uptrend, a downtrend, or consolidation. Uptrend obviously is up, downtrend is down. Consolidation means it's not going nowhere. It's just up, down, up, down, up, down. It's not doing nothing at all. So an uptrend consists of higher highs and higher lows. What that means is the market will do this. It'll never go straight up. It'll do this. Go up a lot, down a little, up a lot, down a little, up a lot, down a little, up a lot, down a little. It does that because price has to retrace and correct itself, give some balance, go up, retrace itself. Because if people are buying all up here and they're taking their profit, there's not a lot of buyers left in the market, so the market will come back down. Then once it retraces, price, and then the buyers will jump back in and shoot, price to the next level. Boom, they get back in. Once they take their money, it comes back down a little bit, and that creates an uptrend. You get the trend line right here, and it's basically, an uptrend. I didn't draw it accurately on, but it's basically this, like an uptrend, if that makes sense. You see a higher, higher, higher low. What that means is this is the low point it was at right here. This is the high point it was at before going down. So that's called the high. This is the low point price was at before going back up. This is called a higher low because this low is higher than that low. You go up to the next high point before going back down. This is a higher high because this high is higher than that high. Right here, another lower high. Another higher low, another higher high, another higher low, another higher high, another higher low. Boom, simple as that. And the way you understand if price were to be done with it is if you have a trend line, obviously, the trend line would actually be drawn here. I just drew it wrong because, like I said, I'll show you how to actually draw it on. The way to get out would be this. Price finally doesn't respect the trend line, and boom, it breaks below. Then you get out, take your money, boom. But that's an uptrend. And a downtrend is the exact same thing in the opposite direction. So a downtrend would be down a lot, up a little. 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 Lower highs and lower lows. So we did this trend line right here, boom, straight down. And what that means is if you look at this right here, we see this right here, boom. That's the high point it was at before going down. This is the low point it was at before going down. This is the next high point it was at before going back down. And this is called the lower high because this high is lower than that high. Then we go right here. This is the next lowest point it went to before going back up. This is called the lower low because this low is lower than that low. The next lower high, the next lower low, next lower high, next lower low, and the next lower high. And the reason and the way you would know to get out of this as well would be price does this and boom, breaks above. Get out, take your money. Consolidation is nothing at all. This is consolidation. Up, down, up, down, up, down, up, down. There's no trend. It's just consolidation. You draw a box around it And all you do for consolidation is you wait for it to break the box to tell you the direction it's going in. Consolidation just means price is not going nowhere. It's just up, down, up, down, up, down. So that is a trend line. So we use trend lines to help us figure out how to trade. So I can see like a trend line right here. So if I just bar replay this off and take this off, right? Look at this. From here, this is the highest point it was at, right? Boom, just draw it right across. What that means, if you scale down, you can look at it. Look at this. Lower highs and lower lows all over the place for a downtrend. Boom, the ellipse tool. This is the highest point it was at. Boom. This is the lowest point it was at. The next highest point it was at, lower high. The next lowest point it was at, lower low. Lower high, lower, it's technically lower low, but I will go right here, lower low. Lower high, crash down here, lower low. We use this to help us because obviously if you see a downtrend, you want to sell. Now you use the trend line with the key areas and the key levels and support and resistance to figure out whether to sell or buy. This clearly would have been a sell because look at this. Let me draw this on my the chart that we've been working on with this video. You see this right here, right? Now look at this. I have a trend line from here down, right? Same thing we had on our other chart. Lower highs and lower lows. Price created the highest point where? At a major area, 112,500. Boom. Boom. Lower high. Lower low. Lower high. Lower low. Right at 110 flat. Lower high. Breaks way below and goes right to the next area, 107. We use all of it together. You feel what I'm saying? Use every single thing you can use in your arsenal to help you figure out where to sell. So once price, placed a market pattern, which I think will be next. Yeah, I'll talk about that next. Here, once it placed that here, it placed a market pattern on a key level. Boom. Then it started a trend line, started creating lower highs and lower lows. You know what I'm saying? If you look at this, look at this. Once you see this lower high created, get in, sell. You would sell right here. Stop loss above the high. So you put your stop loss above the last high point it went to, and your take profit, where you take your money, will be the next key area. So your take profit is there, and you just watch it play out. Look at it. Just playing out, playing out, playing out. Gets to your take profit, boom, get out. And if you miss this area, just wait for it to come to the trend line and then get in right here. Sell. Still take profit, still the same, but now your stop loss doesn't have to be this high because this right now is the last low of lower high it was at before going down. So you put your stop loss above the last lower high in a downtrend and below the last higher low in an uptrend. You feel what I'm saying? So this is a downtrend. Boom, goes down. So that is all you do for an uptrend, for trend lines in general. If I could try to find an uptrend somewhere, I don't even gotta find an uptrend. I can just do this right here. So let me just reverse all of this out. Just take this off myself. Boom, 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 boom. And like I said, how do you know it's over? You see, like, price broke above this trend line. It's not a downtrend no more. But if you were to see an uptrend, for example, look at this right here. Exactly. Just it's a smaller version, not as clean as we would like it, but it's still nonetheless an uptrend. Boom, you look good right here. Price places a low at 107,500, our area. Comes right here, places a pattern. Boom. That's the lowest point it went to. That's the highest point it went to. That's a higher low. It's higher than that low. Higher high. It's higher than that high by a few pips, but it's still higher. Higher low. Higher high. Higher low. Goes way up here. Boom. Higher high. Higher low. So we see all of that, right? And that's how we decide to get in. Let me actually fast forward, keep that right there. And we buy it right here at the first chance we see at a higher low. Take profit is the next key area, which is 110. Oh, I'm got the freaking draw mode on, right? Cool. Got two on. Yeah, cool. The next key area, boom. We just watch it play out. Stop loss is below this starting point because that's where it started at. That's the last, low, aka higher low that it was at. So now, boom, get in. If we actually got in right here, take profit still the same. Stop loss is now below here because that's the last point it went to before, going up. So just constantly adjust. That is trend lines for you. We use all of them to help us trade. Like I said, so now we just went over key areas and trend lines. Now let's go over major market patterns. I won't go over specific ones, but what I will do is just tell you the names of them so you can look it up yourself, and I'll look up on Google with you as well. You should know these names. Let me go on a random pair. I don't really trade. Let's go just to write the names down. Boom. So what you should know is for single patterns, what you should know is what a doji is. And like I said, I'm not gonna get into actual details, but that's in my, my course on the swagacademy.com, like in detailed explanations of all of it and putting it all together. I'm just giving you guys like a little bit of the keys, you know what I'm saying? So single patterns, which means just one candlestick. Doji, Meru Bozu, shooting star, hammer, inverted hammer. Yeah, these are the single patterns you should be looking at. So that means you can go right here, go on Google, type doji pattern. Go to images. It'll tell you what this means. So when you see a candlestick like this, with basically no body, just a bunch of wicks, it tells you price is gonna do this, reverse or do that. You see shooting star pattern. I think that's next, right? Or Mariposa's, I'll get to that in a second. Shooting star. And this kind of has actual details. This means when you see a big body, but a small, no, not body, big wick, small body at the bottom, that means price is going to do this, aka reverse and go down. Whenever you see a shooting star, that just means price is going to go down. Each pattern represents if it's going to go up or down. So this represents it's going to go down, right? Cool. Look at Maribozu pattern. Boom. This just means it's a big body, pure momentum. All of it. It tells you price. It means this. It means it had a lot of momentum. It means whatever candlestick it is, whether it's up or down. If you see a Maribozu, whatever direction it is, that's where price is going to go because it has so much momentum. And all the others. So you can look at the rest of them. Hammers as well. Same thing. For double patterns, which means two candlesticks. Look up. I want to say this off the top of my head. Tweezer top, tweezer bottom. Let's bring this over a little bit. Look up double top, double bottom. Look up bullish, bearish engulfing. So bullish engulfing and a bearish engulfing. Look up, I think those are the only major ones. I may be missing one, but I'm not too sure. But bullish engulfing, double top, and tweezer top. I'll just stick with those for now. There's probably some more, but focus on, like, don't worry about a million of them. Focus on the ones that matter. And that's basically these. So you see a, bullish engulfing. That means this. That means one small red candle and a big green or blue candle that goes above it. That just means price is going to go up. Same with the bearish engulfing. Small green, big red, it engulfs the previous candle, means it's going down. You could look at, tweezer. It's my website. You could look at, tweezer top, tweezer bottom at the same time. You feel what I'm saying? Double top, double bottom. It's my website. It is. Yeah, see, I have all the, I'm not going to show you all the videos. I have so many videos here, in my course. That's, describes it in depth. But even though here, double top, double bottom, tweezer top, tweezer bottom, you can look them all up. Now for triple candlestick patterns, that just means three candlesticks. So when you see three, it means like this or that or that. So that means head and shoulders, aka inverted head and shoulders. I'll put H and S. Morning star, evening star. Those are what you should be focusing on. And you can obviously look it up. Head and shoulders pattern. It means obviously head and shoulders would be if you see like a shoulder, come down, a head, come down, shoulder, that means it's going down. Or inverted, if I can see an inverted head and shoulders. That means price is, left shoulder right here. Comes down, left shoulder, comes all the way down for a head, goes up, comes down, right shoulder, same as the left shoulder, then goes up. Same thing. You look at a morning star or evening star, Forex. Like, just look up these patterns. Like I said, Forex, obviously. I have it all in depth in my course, but for those who are not in my course, just look it up on Google. Boom, evening star, morning star, tells you what that means. So I can go right back to my actual charts, and we can look at those type of patterns. So we look at those patterns and we see, okay, right here, what is this? This is a bullish engulfing. Small red, big blue. What does that mean? Buy. It's going up. We can scale back. Even right here, for example, pardon me. Even right here, for example, we could have had like a small 4-hour box right here for a support and resistance. But what is this? Look at this. This is a left shoulder right here. Head, right shoulder. That's an inverted head and shoulders. We just looked it up. What does that mean? It's going up. Price went up. So like, there's so many patterns that you should know, but you should only focus on the major ones, like single candlestick patterns. There's probably like a million. You should only focus on maybe like 5 of them, like the doji, the Maribozu, shooting star, hammer, inverted hammer. Same with the, the dual candlesticks, which is like double top, double bottom, tweezer top, tweezer bottom, bearish engulfing, bullish engulfing. And for the triple candlesticks, just look up morning star, evening star, and inverted head and shoulders and head and shoulders. Like, you don't got to know too much. Like, and trust me, it gets a lot easier when you study them and like you implement them. It's not as hard as it sounds. It sounds like a lot of different things to know. It's not that hard. So that's that. Now, indicators. I don't use indicators. What an indicator is, and an indicator is exactly that, an indicator. It indicates where a price is going to go in the future. There's so many indicators out there. What an indicator basically does, like I said, it tells you based on metrics and previous history where price is going to go. I don't use them. I only use the moving average, and I put the moving average on here, but I'll show you like, the stochastic and RSI, all that extra stuff, because it's supposed to help you figure out if price is going to go up or down. The problem with indicators is they lag. So just looking at purely price and maybe a moving average, that tells you what it's going to do. An indicator is just taking previous, price and then saying, okay, price did this, 10 days ago, so it may do this now, or 5 days ago, you know what I mean? So you can look up here if you're on MT4 on your phone, it's easy to type indicators and put them on. But if you're on TradingView, type indicator, you can type stochastic, and it'll come up at the bottom. It's an 80 and 20. What that means is what the indicator is telling you is anytime price is below 20 or near 20, it's oversold, which means it's going to go up soon. Anytime price is above 80, it means it's overbought and it's going to go down soon. So this right here is saying it's over 80, but price can still go up as much as it can. It's just telling you what price is doing right here. You see price went up, so this went up. You see price came back down a little bit, so this came down a little bit. Price came down a lot, but look over here. This is kind of saying, this is why it doesn't really work that way, because you see this little line, it correlates with what it is above. So right here, it's saying prices at 35 or 36 on the stochastic, which means it's near oversold levels. But look, price, I'm bugging. But look above, price was just getting started and it dropped way below here and it stayed below 20. It got near the 6 levels. If I go over here, it got near 5 and 4 for a long time. It was there for 1, 2, 3, 4, 5, 6 days. No, 1, 2, 3, 4, 5, 6, 7, 8 at the bottom. 8 days it was at 6. So that's why indicators don't really work. Some people use them, but you got to be careful because they lag. They're only showing you what price did in the past. It can help. It can like I said, confluence. It can indicate and help you, but it shouldn't be like a basis of merit of what price is going to do. You know what I'm saying? So I don't really use indicators. You can look at, stochastics. You can look at, RSI. Actually, let me take the indicator off. Use RSI. It's kind of the same thing. The strength index in terms of how strong, the trend is. Anytime price is usually above, like I think 50, I believe, that means it's very, very strong and it's going to continue. Anytime it's below 4, like there's so many different indicators to look at. So if you want to use indicators, look up stochastic. Let me go back to AJPY and tell you. Stochastic, RSI, MACD, stochastic, RSI, MACD. What else? There's a couple. Oh, moving average. I use the moving average though. Moving average and then a couple. There's a lot of others. Moving average is the only one that's like verifiable and like actually works for me. The others don't really work, but there's Bollinger Bands as well. So like I said, if you're not on my course, just do your research on these and see which one works the best for you. And I'll show you moving averages right now. All right, so with moving averages, so what you want to do is over here, moving average. So I'm not going to explain it now. It's explained in my course, and Google it in terms of if you want to know the actual definition and stuff. But exponential moving averages, we use the exponential, the EMA. It places on the chart. I will make this length 8. That just means the last closing periods of the last 8 periods. You can look for actual definitions, like I said, online. Black, boom. What this means is anytime price is above the moving average, this little line right here, price is in an uptrend. Anytime it's below it, price is in a downtrend. So this is a good confluence that kind of tells you and lets you know that when price breaks below this moving average, price is going to continue all the way down. So sometimes people don't really, buy or sell until it does that as well. So look at this. We have a trend line right here that we had already, right? At a trend line, we had this is basically an inverted hammer on a major area. Trend line, boom, bounce, 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 comes right here, breaks below the moving average. Not only does it bounce off this trend line, breaks below the moving average, then it continues down, creates a Maribozu on a major area. That tells you price is gonna go back down. So all the moving averages, I just have one. Some people have two. They have, I can draw another one right now just to show you. They have two. They have EMA and regular. And what it does is they just have the yellow one. Take that off. Boom. Boom. The yellow one is red. So if this is easy for y'all, you can do this too. You can have two, a 8 EMA and a 21 EMA. Let me take the style for the right here. Should be 21. It's really far away, but yeah. But all it means is I want to make it close. Let's see if I can make it 18 or something. Cool. Let's make it 14. That's perfect. Okay, cool. All it means is the last closing periods, the last 14 periods. Like I said, you can Google it for sure. But what these two means the same thing. But it's not even above or below anymore. It just means whenever the red moving average crosses above the black, and you can make it blue to make it easier for you. But whenever it crosses above the blue, price is in a downtrend because the red moving average is on top. Now you see how this crosses over? Whenever the blue crosses above the red, guess what? It's in an uptrend. Get in. Right here, price clearly makes, a higher low right here. So it's a bullish engulfing, creates a higher low. You know what I mean? You can scale until 4 hour, creates a higher low. Got a trend line right here. Boom. The moving average crossed over right here, crossover moving average. Boom, buy. So for me, I use moving averages because they work for me. And obviously, if you have a moving average on a daily or weekly, it'll take a lot longer for it to do it. You want to look at the moving averages in the 4 hour and a 2 hour because they give you a much more clear example of what price is doing right now. But I use the moving average a lot. I just use one. I don't use two anymore. I used to use two. I just like one to keep my charts cleaner. So what I'll do is I'll just remove indicators and I just draw my indicator back on. Actually, I already have it saved. It should be here somewhere. Indicator templates. See, 8 and 14, what we just had on. But I just keep the 8 EMA on, keep it black, boom. And all this tells me this one, because it's only one moving average, it's not two, so there's no crossover. Whenever price is above it, it's going up. Whenever price is below it, it's going down. Simple as that. Lastly, Fibonacci. The last thing for technical analysis, Fibonacci. What Fibonacci is okay, the definition is really, really weird. We can just look it up. I have it in my course. I just don't want to log into my course right now, even though it's already kind of logged in. You can look at the Fibonacci, definition. Let's look it up. So all it is so it's a sequence. It just means one, like I said, is over the preceding one. So like in terms of like knowing it, you don't have to know this at all. But it just means 0, 1, 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8, 5 plus 8 is 13, 13, plus 8, 21, and so on and so forth. And they take these, like the 144 and 89 and divide it and get a number. 144 and 55, get a number. 144 and 34, get a number. You don't got to know any of that. You just got to see it right here. Let's go to AUDJQI. Back to this one, right? You look at it here. It's a retracement tool. So what that means is when you see price retrace, remember I told you like uptrends and downtrends never go straight up or straight down. It'll go up, retrace a little bit, then go up, trace a little bit, then go up. What the Fibonacci retracement will help you do is it'll go up, and then once you retrace, it'll get to a level on the Fibonacci, and then the Fibonacci will tell you where your take profit should be at, and then it'll get to that level. So let me show you right now. So we have 100 flat, 78.6, 61.8, 50, 38.2, 0. And these numbers come from dividing, the 0 and the 1, the 144, all that math stuff you don't got to know. You just got to know these numbers. This 27 extension is the take profit at all times. So what we do is we see this first leg, right? This huge move down here, right? Then price comes up and retrace, right? Look what it does. So you place, wherever you see price start at, you place it right here at the starting point, and then you drag it down to right here. Price goes down, Boom, right here. So you see, this is the lowest point it went to before going back up. So we place price here, and then we can easily get the bar replay right here, and then just place it right here. So you see price, it gets to the 50 extension level. It gets to the 50 retracement level right here. Boom. And then what does it do? So like right now, people who don't really know how to trade will try to buy this. We as traders know this is just a retracement. Like, it's not going up. It's just a retracement. Boom, retracing. And then finally, once it moves all the way down here. Boom, just like that. But this one, it goes way past the 27. If we wanted to, there's other levels you can add on. You can add a 61.8, which is way down here. Like, you could have had that level too. It's 27, 414, and 61. I just use 27. I don't use 61.8, so, but it goes to 61.8. So you can have both on here. Boom. But these are your take profit levels. Take profit 1, take profit 2. Boom. That's all Fibonacci retracement tells you. So if we can go to Euro USD, we can do this all day. Right here. So you see prices right here, right? So we place, you can even have it right here. So let's do it in order. Here to here. This is the first high, the highest point it went to, draw from here. This is the bottom point it went to, right? Boom. Let's bar replay this. Bar replay means you can go back in time. I think you can only get this with the pro account. Take this, bring it right here to this level 50. You see it, price is retracing. We know it's not going up. We know it's going back down, it's just retracing. We press play. 27 will be our take profit, or 61.8 overall, either or. Boom, price goes down, go to 27, goes to 61.8. Boom, get out the trade. You won your trade already. Now, when price comes right here, delete it. Now look what price is gonna do. Come back up, and guess what? We know price is not going up. So this is the next highest point. Boom, place at the lowest point, which is here. We know, even though we see this big candlestick, no, like, it's still a downtrend, because look, it's still below the trend line. You know what I mean? Like, until price breaks this trend line, we're not buying it. Boom. Bounces off the 50, the middle of 61.8, but the 50 extension. Our take profit is below 110. It is now 109.432 or 108.80. And now look, we press play. Price goes down. Boom. Get out the trade. You made your money. Boom. So the Fibonacci extension or Fibonacci retracement, it just tells us when price is retracing, what price is doing. You need that every single time, because you got to understand, like I said, price will never, ever go straight up. Well, price will never, Price will never go straight up or never go straight down. What it'll do, like I said in the beginning, it'll go up a little bit, down, or up a lot, down a little bit, up a lot, down a little bit. And if you do this, you can even have right here, Fibonacci, from the bottom to the top, the highest one I went to, bounce off to 38.2, got right to 27 right here. Boom, take profit, get in, get out. That's all you got to do. You see what I'm saying? So, boom. So that, kind of wraps it all up. If I can go back to AUJPY, you got to use all of them together. Bring it one more time. Text, we got Japanese candlesticks. We have, I think we did key levels, aka support and resistance. We had major trend lines, major market patterns. What else? I think we had indicators, but we only use a moving average, so EMAs, exponential moving average, and Fibonacci. Those are your only 6 things you really need in order to trade for technical analysis. These are the only things you need. That is it. Nothing else. And we just went through all of them. So that's a lot. It's a long ass video. Gang. It's a long ass video. Like I said, let me know what videos you guys want to see next, because like I said, I try to break it all down for you guys, because a lot of y'all may not understand what technical analysis is. Like, that's the fundamentals of this trading thing. It's 90% technicals, 10% fundamentals. Like, I'll do a video on fundamentals later on, but like, you need to understand what technical analysis is. That is it, end all be all. Like, that is how you trade the market. Technical analysis, purely that. And those are your 6 trades, or 6, tools to use. You don't got to understand, all this other stuff over here. You don't, like, none of this matters. All that matters is the stuff that's highlighted, which is trend line, horizontal line, which is support and resistance, the array, support and resistance as well. Over here, just the Fibonacci retracement. Over here, just the rectangle and the ellipse tool to kind of like measure out what price is doing. It's all you got to know. Like, it's really simple once you get the hang of it. So, gang, let me know. Like I said, like, comment, subscribe, and let me know what videos you want to see next. Like I said, I'm trying to dump out videos Sunday through Thursday, I believe, because Friday the market closed at 5 p.m. Saturday the market's closed. So Sunday, Monday, Tuesday, Wednesday, Thursday, you should expect a video from me every single day. Hold me accountable. I'm gonna do exactly that, and go from there. So I'll holler at you guys. It's a long ass video, I know it is, but I hope that it helped you guys in your trading game, especially if you're just starting. And if you're not just starting, obviously this video isn't really applying to you because you kind of already know this stuff. But if you're just starting, hope this video helped you out, and holler at me in the comments on my Instagram, SwaggyCTV, or get a free consultation on my website, theswagacademy.com. The link will be in the description below. So gang, I'll holler at you guys. Jersey.